Good afternoon. I hope you are all enjoying coverings and having a good time here, learning a lot and seeing a lot. And I'm Jan Hahn. I'm a member of the National Tile Contractors Association, and it is my pleasure today to introduce the speaker, Matthew Saltzman. So, Matthew is the CEO of Louisville Tile Distributors. LTD is a multi-state distribution company of flooring solutions based in Louisville, Kentucky. With over 30 years of experience working in the capital markets with major Wall Street firms, Matthew has been involved in many sectors in multiple aspects, including finance, operational turnaround, and strategic planning. During his career, Matthew has owned and operated multiple businesses for his own portfolio. Prior to becoming CEO of Louisville Tile, Matthew was the managing director of strategic advisory services for Strothman & Company, managing director for J.P. Morgan, and began his career with Drexel, Burnham, and Lambert. Matthew holds a BA from Hobart College and an MBA from the University of Connecticut. Please welcome Matthew Saltzman.
Okay. Can everybody hear me?
Yes.
All right. That's one thing down. Worked. Okay. So let me ask you, just to get started, the topic is bridge over troubled waters, and it's not as dire as it sounds. But as you're all aware, times have changed. Things are different. Let me start off by asking, how many people in here are business owners? Okay. Got a little bit of work to do on this. I'm going to ask the question again at the end, and we'll find out how many of you are business owners at the end of this conversation. So I'm going to start today, and want you to think about something. If you're not a business owner or you are a business owner, you go to that four-letter word for some kind of reason called work. And what is your most important goal? What are the things that you really go to work for? Why do you do it every day? Is it because you own a business, you want market share? Are you there for fun, revenues, family? So think about why you go to work every day. These are the goals that everybody has when they own a business. And just to give you a little bit of insight, every one of you is a business owner in some form or fashion, and that's part of what I'm going to try and show you today. Does anybody have a goal that's not up on the screen? No? Okay. So 2020 was a pretty interesting year, right? Changed everything. What kind of things do you think changed since 2020? Anybody have anything? This is group participation. You get points for this. We stamp your travel card or something. You get closer to the free Yeti.
Interest rates.
Interest rates. That's one. Anybody else?
Working from home.
Working from home. Okay. That has changed. So, interest rates. That was the first one. Wage inflation. Anybody notice that costs more to hire the people who actually want to go to work and not stay at home? How about the supply chain? Anybody notice a difference in the supply chain since 2020? Like there is none? How about competition? Finding competition working a little differently, competing against some things that you hadn't competed before? Anybody notice that? Freight? Consumer behaviors? Besides the people living at home, they're probably shopping from home, doing more of that. So e-commerce is big, technology. Speaking of technology, how many people here are familiar with the new BART? Anybody know who BART is? How many people know who BART is? Okay. Anybody familiar with the Microsoft chat bot thing, the AI chat? BART's his evil twin. Comes from Google. And it's 3 times more powerful and probably has 10 times the amount of information that the other one has. So, intelligence, artificial intelligence, is probably something that's dramatically changed just in the last 6 months, let alone from 2020, and is going to have a major impact on every business and every company that's out there. Everybody's a little bit older, right? So your age has changed. You're a little bit older. You're a little bit closer to whatever your goals are, wherever you want to be, whatever you want to do. Time has progressed. We're out of the bubbles. So that's something else that's changed since 2020. So let's talk about the impact of the changes. Anybody notice an impact on their inventories? Tighter? Some a little bit more bloated because their stuff's not moving? How about sales? Have people noticed anything in their sales? An impact on sales since 2020? Up or grow? Yeah. 2020, 21 was a good year, believe it or not. Labor. People have trouble staffing? Tight? Get less for more? Kind of like the inflationary environment we're in now?
Labor also has new expectations.
It does. They have expectations of us, which is a big problem. Got to figure out how to turn that thing around again. But no, labor has expectations. Labor's powerful. When they start, going after Howard Schultz and unionizing Starbucks, that tells you where the power lies. It lies in the people. They're tight, and you can't get them. Cost of capital. Cost you more now to get money? A little bit tighter to get? That's a big change in the last 12 months. Investments. Anybody who's got stock market portfolios understands the nature of investments in troubled waters. Anybody here have stocks? Anybody here have a nice smooth ride the last year? How about cash? Cash is a lot of cash floating through the system. There's a lot of money out there. But cash in the businesses is tight. Anybody who runs a business here notice that their cash is a little bit tighter? The flow is a little bit tougher? 2023 is not exactly very friendly to start. And how about margins? Anybody experience something with their margins? Good or bad? Because all these things here have an impact on that. At the end of the day, margins is the result of everything that you see up there. So you have to be paying attention to all of these things. And as the world changes, it changes slowly, but it changes quickly, as you can see. Just the difference between October of last year and April of this year is dramatic. You've got interest rates, mortgage. Let's take a mortgage, for example. Mortgage was, 4.5% last October? Close to 7% now. It's a big jump. So when you run a business and you own a business, there are two parts to it that you must think about. There are controllable aspects and there are uncontrollable aspects. It's kind of like life. Certain things you can control and certain things you get. They say, something happens. It's kind of the way it works. So if you think about controllable versus uncontrollable, what do you think some controllable things are in a business? Because that's really where we're focused on, a business here. And again, think of yourself all as owners. It's one of the sea changes that you want to think about when you work at a business. Whether you're on a line or you're running a department or you're actually the one that's responsible to make the payroll and pay the bills, you're all owners of something. Because without ownership, you don't have any accountability. Without any accountability, you have chaos. So what kind of things do you think are controllable? Anybody? Who you hire. That is controllable. Budget? Is that what you said? Yep. That's a good answer.
The work environment?
The work environment is very controllable and kind of important, huh? Considering that the workers now control the world. So it changes that way. Those are all good things. Work environment is internal politics. That's controllable. Geopolitical is not controllable. So you can't do anything about that. My point in this slide is what you can and what you can't do things about. Internal financials, somebody said budget. Macroeconomy, you can't control the macroeconomy. You're only a small little tiny piece in a whole big thing. Internal spending, you can't control what you spend and what you use your money for. You can't control what the customer's going to spend. You can only influence that behavior. You cannot control it. Internal activity, how many calls you make, what you do for business, how you handle yourself internally. That's all controllable. You can't control the outcomes, though. You can only influence the outcomes. Somebody said labor. Labor is controllable, who you hire. Labor markets are clearly not controllable. How much debt you want to take on? That's totally controllable. The cost of that debt is another story altogether. I'm not sure anybody has control over that now or into the foreseeable future. And at the end, efficiencies. How efficient are you? How efficiently do you run your business? Where do you reduce friction? That's all controllable by you as an owner, whether you in fact have all the stock certificates, or you just control a department, or you just work in a certain part of the business. You own those efficiencies. You own those inputs. But the market inefficiencies, such as supply chain, those kinds of things, you don't own those. You just have to work with them and deal with them. Does that make sense? Okay. So in the end, you do control your business, but you can't control your competitors in the world. So every day, you can only go to work and do what you do. Oh, look at this thing is down there. You can, that's helpful. So you can't, makes me look smart now. So you can't control your business, but you can't control the competitors and the world around you. And I can't tell you how many people I've worked with over the last 15, 20 years in helping them manage their businesses that were more concerned about what everybody else was doing and forgot that it was all about what they were doing, because it doesn't matter what everybody else does. It's what you do every single day that makes the difference. And that's the point to the whole thing. A lot of that translates into your lives. I mean, I have kids, and anybody here who has kids has had that same conversation where the kid wants something. It's like, you say, no, and they say, but everybody else has it. And I'm like, okay, then you should go talk to everybody else's mother. And go get what you need. So you can't control your own world no matter where you sit in the company. And the idea of what I'm trying to get at is that everybody needs to have an ownership mentality. And that's the way companies become great. So what are the rules to success? How do you make a business great? How do you drive success through the organization so that you can achieve that stuff in that blue cloud on the first slide that I showed you? Managing your business requires a proactive behavior. How many people here have been in a business where they said, how was your day? And you said, I don't know. I just solved problems all day long and just ran around all day. Anybody ever have that experience at work? Don't be bashful. Show your hands. It's okay. They know. Everybody has. That's reactive behavior. If you're going to run a business, you need to know your numbers. I can't tell you how many times I would go into companies, and even in this industry, and ask people about their numbers, their financials, how the business runs, which is essentially their vital signs, just like a human being. And they had no clue. They didn't know the margins. They didn't know the revenues. They didn't know their inventory. They didn't know any of the aging. And I just looked at them and I thought, you got like less than half a chance to live in this thing. Because if you don't know your numbers, you have no idea how healthy or unhealthy you are. How many people in this room, just by curious thought, how many people in this room at least once a week get on a scale and find out how much they weigh? Okay? Most of you. You know your numbers. When you run a business, you need to know your numbers too. It's the same kind of thing. Then, how many people get on the scale and look at the scale and go, you're a liar. There is no way that that's the right number. Give me that Twinkie. Right? It's broken. It's broken. I got to go get another scale. It doesn't work. Those pants aren't working right today. I know they'll fit tomorrow. They shrunk. Yeah, somebody shrunk them in the washing machine or in the dry cleaner. He shrunk them again. Point is, you have to know what the right numbers are to review when you're running a business, and you have to accept the facts that those numbers tell you. You have to use the numbers to your benefit. You have to know what they're telling you to do and where the issues are. And this is where ownership comes in. You have to hold your people and yourselves accountable in order for those numbers to mean anything. Because numbers by themselves are just numbers. But without activity, they're useless. But with activity and with accountability and with inspection, you can get to some place that you want to be. That way you can make data-driven decisions. And most importantly, you can teach your teams how to make good decisions and how to use information. For those people in here that have control of the numbers in their companies, I highly encourage you to become transparent if you're not already and share those numbers with the people in your company. When you don't share the numbers with your company and with your people, A, they have no way to measure themselves. B, they can't participate in the success and the failures. C, half the time they think you're hiding something and they're not being treated fairly. And D, you cannot hold them accountable for anything because they don't understand how their piece fits into the whole. And if they don't understand how their piece fits into that whole, there is no way that you will be able to manage to the results on a holistic basis, and you will spend all day in silos, and then somebody at the top is going to have to try and put it together, and that is way too much effort for any single individual. In our company, we share the numbers freely. It's a very closely held, family-owned business, of which I am not one of them. But that family allows us to share all the numbers inside the company. And since we've shared those numbers, the performance of the company, the camaraderie around the company, the culture of the company has improved dramatically. And we now have people coming to us with innovative ideas on how to save the company money. And we actually have contests for that. And we tell them how much they save, what they get, and then we teach them how to present it, how to implement it, and we let them project manage the change. It's an incredibly empowering experience, but we couldn't do it unless we actually were transparent with the numbers and shared that experience with them. So when we all win, we all win. When we have a problem, we all have a problem. And I'd rather have 250 or 260 people trying to solve a problem than 3 people who know about the problem and expecting everybody else to solve it for them. So you have to do that. You have to build your culture. You have to be very strategic in what you do. It's one of my favorite words. Strategic versus tactical. Proactive versus reactive. And as they say in the game, hope is not a strategy. Staring at that scale and hoping that tomorrow it gives me a different answer is not really a good strategy as I'm reaching for that second piece of cake and the ice cream with it. It's probably not a good choice. So hope is not a strategy. Any questions? Comments? Money? No? Okay. So who are the storytellers in your business? These storytellers tell you all you need to know about the business. You don't need business plans. You don't need written documents. You don't need any of that. I could walk into any of your businesses, take these 3 storytellers, and I can tell you every single thing you need to know about that business. I could tell you where your problems are. I could tell you which departments are in trouble. I can tell you where you're going to be. Everybody familiar with these 3 storytellers? Okay. So let's start. What do you think the most important question these storytellers that you can ask them? What's the most important question? It's one word. No help from my team. They know it. What's the most important question that you can ask anybody? One word. How? So that's close. Think about a 5-year-old child.
Why?
There you go. That's exactly right. Why is the most. Why? Why are the numbers this way? Why are we seeing this trend? Why does it work that way? Why do we have so much inventory? Why is that inventory aging? Why are we not collecting our receivables? Why are our payables out? Why is our cash down? Those three things, the income statement, the balance sheet, and the cash flow, a lot of people just look at them and they check the box. I will tell you that 80% of the people look at a balance sheet and think that it's just this necessary thing that has to be in there, but they don't quite understand why they have it. The whole business, as you'll find out, is managed to a balance sheet. So why is an incredibly important question, and if it's not something you're asking all the time, you should be. If your culture doesn't allow people to ask why, I would suggest you change that. Allow yourself to be challenged. As long as you're challenged in a healthy and respectful way, you will find amazing things happening inside your companies. So the income statement is a scorecard. Most people look at their revenues and they talk about how well they're doing, right? Oh yeah, last year we did 100, last year we did 200, last year we did 50, this year we're going to do 60, then we did 40. Revenues are fine, but that's not the story. Because it's not about what you make, it's about what you keep. Right? Everybody here pays taxes, right? Anybody go home and spend their money other than the U.S.? Anybody here work for the government before I ask this question? Anybody go home and just think that they take in X number of dollars as a salary and that's what their budget should be? No, it's what you keep at the end. And you have to allocate it. Business is exactly the same way. So revenues is a big portion of the income statement. Then you have COGS, cost of goods sold. The COGS is a work of art, and sometimes it's not. It's a work of something else. But COGS can have multiple components that people put into it. And depending on how you actually calculate those costs, they give you your resulting margins that come down at the end. Some people put freight. Some people put direct labor. Some people put shipping and stamps, advertising, paper, all kinds of stuff. It can all go in there depending on how you want to do it. My suggestion is that when you have COGS, you boil it down to the simplest equation possible so that you can isolate everything else which is variable around it. And then you can isolate, different types of costs. If you're putting the fill, the peanuts, for example, that go into a package, or the styrofoam, and that's part of your COGS, well, that's a separate item that can be sourced someplace else. As you'll see, it's about relativity, not absolute dollars. So you can then isolate that out. So your COGS is very important, and in the income statement, it gives you your margins. What does that margin allow you to do? Who said that? That's right. It's exactly what it does. Because you cannot run the company on your revenues, because you already lost a huge chunk of your revenues in the COGS. All you have left to run the company is on that one margin, that gross margin. That's the real money. It's kind of like hospitals. Anybody here ever work in a hospital? Well, let me tell you how they work. The way they work is that they tell you that they're a $200 million revenue hospital. But that's because that's what the manufacturer suggested retail price of your billing is. And then they take all these insurance payments, and the insurance company knocks them down 20, 30, 40, 50%. And it really turns out that they run on about 25 to 30% of what they claim are their revenues. Because they don't worry about what they collect. They run it on what the top line is, and then they try and model their spending on that. It's complete insanity. I fixed 2 hospitals doing this, and when I got there, the lunacy was incredible. One of them had 4 days of cash on hand. Does everybody know what that is, that measurement for cash on hand? Because we're going to talk about that in a little bit. Had 4 days of cash on hand and didn't know it. That means if they had a snowstorm and the mail didn't run and the internet went out in 4 days, they had no more money to run the business. Not a place I want to be in their emergency room at that time. So that's margins. That's what's left to run the business. And what's running the business is your SG&A. That's the big fat piece underneath. And the SG&A has controllable and uncontrollable expenses. It has investment, maintenance, and waste. And that's where you find these major categories of things. You find your controllable expenses in the SG&A, and you want to carve those out and identify what they are. You have uncontrollable expenses. Anybody know a form of an uncontrollable expense? Rent. Rent's the most obvious. Once you sign that lease, it's there. You know, even the electric bill moves around, but it's there. But it's really an uncontrollable expense. Controllable expense. Anybody have an idea what that is? Yeah, labor. Labor is a controllable to a degree. It's a controllable expense. And it's a controllable expense in terms of quality that you want to get, number of people that you want to hire, and what you want to do with them. And every one of those people is a business unit, and there has to be a return on investment for that person that you hire. One of the things I experienced also when I did all these turnarounds, and I did 75 of them over the last 15 years for different companies before I came to Louisville Tile, every problem was solved with two components, every time. I just need more money and I need more people and I'll solve the problem. I'm like, no, you're just going to go and dig a deeper hole and repeat the problem on a bigger scale because nothing's going to change except you have to feed more mouths. So you find controllable and uncontrollable. Investment. What do people think of when I say investment? Stocks? Assets. Who's the finance guy in the corner? Assets. Right. Anytime you buy a piece of machinery, is it an expense or is it an investment? Should be an investment, right? Anytime you hire a new person in your company, that's actually an investment, your greatest asset, your biggest asset. But you have to start looking at things from that perspective of being an investment. How about maintenance? Anybody here have machines or equipment in their offices? Any kind of equipment? Stapler? Building? Copiers? Anybody here use a computer? Anybody have a laptop go down in the last 3 or 4 years? Anybody want to throw their laptop against the wall in the last 3 or 4 years? They all need maintenance. They need to be trued up. They need to be maintained. The software is changing dramatically. We just talked about AI. It's all there. So there's maintenance that has to go into the SG&A. And then there's waste. And waste are things that are nice to haves, luxury items, not checking your expenses, being able to buy smarter. So I'll give you 2 examples of waste. Waste in one company was the CEO proudly told me that they didn't have waste. He ran to Costco and Sam's and Kmart and Target because he went to get the best deals for toilet paper and paper towels and pens and stuff like that. And he was really proud of himself. I said, see, I'm really watching the pennies. I said, yes. And you are now the most overpaid errand boy in the entire place, and I'd like to fire you. Because he made more money than anybody, and that's what he was doing. There's no return on investment for this guy. That's a form of waste. Another form of waste, I'll give you an example of something we found actually at Louisville Tile. We were spending time cutting pieces out of rolls and selling little pieces out. And when we actually calculated the labor to sell the pieces versus selling them as a single roll, it cost us a fortune. So we started just selling it in bulk. And we started buying and looking at our shipping to have full containers coming in, or trucks or whatever it was, our freight guy, changed the way that we shipped in and was able to save us a lot of money simply by buying better. It's not the most elegant explanation, but it gets there. It helped us get in and buy better, and it saved us money on the inbound. All those pennies added up to dollars eventually, and our whole mission is we look to eliminate waste inside our SG&A whenever we can. So there are different ways to look at it, and in the fact of being business owners, those concepts and most of those activities did not come from the people who own the stock. Those thoughts came from the warehouse and the warehouse guys, who happen to be the lowest paid guys in our place, but have an ownership mentality and are part of the team. And they understand the culture that we talked about building. And once you get through the SG&A, then the income statement brings you down to EBITDA, that magic number that everybody thinks about. But wait, it still now doesn't belong to you. There's a few things that come next. And that's net income, because EBITDA is before depreciation and before that nasty little bank that takes all its interest payments out from you. And there you go. And your amortization and your taxes. Oh yeah, the taxes. The guys that can't spend fast enough. So that gets you to net income. That's the income statement right there. And it looks like this. I don't know if people are going to be able to see it, but it's a double trick. So you start here, there are your COGS, and you see this right here? These are percentages. We've been talking in the framework of absolute dollars. Each one of these is a percentage of something, and that's what you need to think about. It's not the absolute dollars. It's the relativity of the numbers. How do those dollars relate to, there you go. How do these numbers relate to both revenues? So here's your gross profit dollars there, your margins. And then what's important, do you want to measure your wages as it relates to revenue? Or do you want to measure your wages as it relates to what you actually have to run the business? So you want to measure things based on what you really have, which is controllable versus uncontrollable. A number of people that I've talked to in the past, and there are a lot of people, will look at this in terms of how it relates to revenues. In our business, that doesn't make a whole lot of sense because our cost of materials are so high that we only have a small amount that's left. Somewhere, in some cases, as low as 18, 20% on certain products, and maybe as much as 40, or if you're Scott, you can get 50. But the rest of us mortals, we only get about 40 at the high end. But that's kind of how you have to look at it. And so what's not on this screen, but should be, is that every one of these categories should be a percentage of both gross margin and of revenues. And you measure them both that way, and you run them to those ends, and you model them. So when I owned restaurants, the rule of thumb was rent should be about no more than 8%, labor needed to be no more than 28%, food cost had to be about 28, 29%. Then you had all this other stuff. And then if you were smart, which I wasn't, you would have realized before you invested any money that this is a very skinny model and restaurants make absolutely no sense at all to invest in because there's nothing left. And there's not a thing you can do about it. But here we have a really good business where we're distributors, and if we can manage our business down to 9, 10% at the bottom line, that becomes a very powerful business. And then it becomes a question of how do you build a platform and how do you build an operation. But to get to that level, you have to listen to all the storytellers. So that's the income statement. Any questions on the income statement and how it gets used? Okay. Now here's the balance sheet. And as I said, this is what you manage to. And the formula is assets equals liabilities plus owner's equity. And most people really don't understand. At this point, they stop on the balance sheet. They're not sure what it really is supposed to do or why they have it. They just know that the account's annoying as hell, charges them an extra $5,000 to prepare this thing. and it gets stuck in a filing that nobody looks at. But the truth is, the balance sheet tells you everything you need to know. Has everybody ever heard the expression bulletproof balance sheet? Where somebody said they have a bulletproof balance sheet, or they have or the banks talk about having a really good balance sheet, or the Fed has a good balance sheet? That's because the balance sheet is your fortress. It's what keeps you home healthy. It keeps you alive. So your assets, you have cash, your receivables, as long as they're good receivables, your investments, liquidity it shows you, and your depreciated versus replacement versus real values. These are things you can garnish out of a balance sheet. And then it also tells you your debt, your accounts payable, your lines of credit, other debt that you have in short term, your long term, your bank, your real estate leases, which now on all your tax returns you're going to have to recognize on the balance sheet, long-term leases, and they're going to become a liability for you. And shareholder loans. How many people have seen owners that have shareholder loans in the business because it's a way to take cash out, and suddenly you get a balance sheet from a business and it's got millions of dollars of shareholder loans with about a 0% chance they'll ever be repaid, right? May not make a difference to you while you operate and own that business. It's going to make a tremendous amount of difference to you the day you decide that you want to sell that business. And then you have retained earnings. Each one of them tells a different story. The cash, if you look at that balance sheet over various periods of time, will tell you the health of the business and how that business is trending, whether or not it's consuming or it's generating. Your AR, that's a whole nother story. Every time we take over a company and do an acquisition, one of the first things we look at is aging AR, and we look at it in different pockets of time. So we can see if there's an AR aging problem that's emerging, if it's consistent, if they run their business right, if they're harvesting their cash. And a lot of people will carry AR way past 90 days and just leave it on the books. It's kind of like it's kind of like that horse at the Derby. The further away that it gets from you, the less chance you have of ever catching it. People have to harvest their AR in order to generate cash. And aging AR is problematic because if you don't collect it, it's harder and harder to get it. And then you become a collection agency and you're not focused on the business that you have, which is to either distribute, contract, whatever it is that your core business does. Liquidity is very important. And then the big thing here under assets is everybody sees on a balance sheet how much they have in assets. Well, that's after they're depreciated. But that doesn't tell you the story, because to replace what's in your company on those assets could cost you 5 or 6 times as much as what's listed on your balance sheet as an asset. So you can look at it either as a hidden asset or an unstated liability, because at some point things wear out and have to be replaced. I have a company that was a client for years and years, and they were in the fabricating business, and they had a paint line, an e-coating line. To replace the e-coat line would cost about $3 million. They were carrying about $250,000 on their books, but that's because they depreciated this thing over 20 years down to nothing. And now they have this asset. And then you have to ask yourself, okay, if they have that asset, is that really a benefit? Well, they better have a corresponding liability in their SG&A, because this story is telling me that they've got a maintenance problem. I got a 20-year-old piece of machinery that probably requires a lot more maintenance than a 20-day-old piece of machinery. So there is a trade-off there. So when you look at that business or you look at your own business, you have to think to yourself, what is the true story? What is this fact really telling me? Is the fact telling me that I have a maintenance problem that I have to invest in? Or do I have a hidden asset that's just not being recognized? And then you have your debt, which is your short-term, your AP, your aging AP. Is it ballooning out at the end? Are you starting to treat your vendors like a third-party bank? An unsecured bank that you're just borrowing from because your AP is blowing out the other side and your ratios are off. You have long-term debt. You know, you can borrow from the bank, but eventually that catches up to you. So you want to make sure you have as little debt as possible, or that there's a way to repay it quickly in a reasonable time. And the other thing is, these are short and long-term. This story tells you, are you matched up? Are you using short-term debt to cover long-term problems? Because you're using a line of credit for everything that you need, that's a long-term problem? Or do you have longer-term debt matched up with longer-term assets so that you have time to bring them back to zero and pay them over time? So this balance sheet tells you a lot of different stories. And then your retained earnings, that just tells you really what the true health of the business is, because over time, if you look at snapshots, you'll see different things. And this just kind of lays it out for you again. It shows you pro forma, and it shows you another category here called goodwill, which these people in this example obviously made some kind of acquisition for more than what the assets were or what the business was worth. And goodwill's really nice, but you can't eat it. So it doesn't really do much for you except sit on the balance sheet as an asset and make you feel better. But it doesn't. There are your accounts payable. Are they expanding? Your line of credit, is it an evergreen line of credit where you're just running it up against the line of credit all the time and you're not paying it down? You just keep paying the interest on it and just cycling it back? That's a problem. Because when the bank comes in, if they cut your line down by 10, 15%, and they tell you got to make up the difference, and now you've got a term note for a big portion of it, and you've got the line of credit, and you can't borrow anymore, something's got to give. You got to get the money from somewhere. That's when you see companies start to cut people. So again, you want to be way ahead of the bank who manages in a rearview mirror by being forward. There are your long-term liabilities, your equity, and then there's your shareholder equity there. And you can see here equity goes up and down depending on what you do. So the balance sheet's very important. But now let's talk about the most important thing. What do you all work for? You work for the money, right? Show me the money. Well, this is the most important of the three storytellers. The free cash flow and pro forma that you have is the most important one that's there. How are we doing on time? 1:13? Okay, pick it up. So you got sources in the cash flow, the uses, talks about non-cash items in there, what's residual, and it points out what trouble could be. What kind of trouble could you have from the business because of the cash flow? Everybody's been in a place where you're moving along, the sales are coming in, but the business starts to seize up because it doesn't have cash. Cash is like oxygen. It's the oxygen for the business. It makes it go. This is what a cash flow statement can look like. You can see here, you've got your net income, but then you have adjustments to net income, up and down, any kind of sales of the fixed assets, your accounts receivable. If you're harvesting too many accounts receivable, you'll have a increase in your assets in cash, but ultimately you're just bringing the money forward unless you're really increasing your revenue. So it's a balancing act for all that kind of stuff. What did you do? Did you borrow any money? How did you get the money? Did you finance it? Do you have interest payments? So this goes on and shows you where all the real money is coming from. And as you go forward and build out the pro forma, you can see exactly where the pitfall is that you're going to drive into, the trouble that you could find. And so what are the key metrics that you want to look for when you're managing a business? You want to basically look at operating, which is cash. How do you stack up with your AR versus your AP? You want that ratio to be closer to 2 than you do to 1. How about your days of cash on hand? You need to measure that. You need days of cash on hand. How long do you have if everything stopped that you could feed this business? What's your clear cash, including outstanding and purchasing clearing? Everybody here has money that they've written checks against, and everybody here has situations where there's a float. Well, float counts. It counts. Just because you drank that milkshake 2 hours ago and it's not quite on the scale yet, it counts. It's coming. Your average days of AR. That's very important. That's how quickly you're harvesting your money. What's your average days outstanding? Are you collecting in 45 and paying in 30 because you have terms on your AP of net 30 or 30 that you're paying on? I mean, I don't have the time because we're running out at 1:30, but that hospital I told you about, one of the problems was the guy paid all his bills to capture the 1%, and he had millions of dollars in receivables that he wasn't collecting. Why did they have no money? Because he was paying fast and collecting slow versus the other way around. But then he got to collect unemployment shortly after. That was good. In your inventory, you want to check out turns. How many times can you turn that inventory? How many days of sales outstanding? What about each SKU? What's the average years of SKU that you have on there? I've been in places where we went in and measured line by line and found out that not only was the company still buying stuff, but they already had 200-300 years worth of inventory on the thing. Literally, it was small pieces, but they had this stuff based on the sales over the last 6, 12, 9 months. And they were still buying this stuff and nothing was moving because it just was automatic. It just kept coming and nobody looked at it. What are the trailing? You have to look at trailing periods of activity, and then you can set par levels inside your companies. So you can know how much do you have to carry before you have a problem. What are the real sales doing as you go along? Are they trending down? Then your par levels should come down. Your inventory rebuild doesn't have to be that much. A 2-month supply or a 60-day supply is a different number when you sell 5 things a week than it is when you sell 20 things a week. And then what's your aging on the inventory? Big issue. Everybody here in this business is like a hoarder. The business is built for hoarders, reformed hoarders, unreformed hoarders. Everybody's got inventory in their warehouses that, well, somebody's going to buy it someday. I'm not going to do it. I'm not going to be the one to get rid of it. Nobody's buying the purple tile with the yellow dots. Trust me, throw it out. Write it off. And then you have to look at your revenue generating stuff. What's your cost of revenue? Measure your sales teams. We're in the process of doing that right now. What does my salesperson cost me, including travel, entertainment, bonuses, commissions, everything else, as a percentage of revenue that they generate and as a percentage of their gross margin that they generate? It will be eye-opening to some people. What's my gross margin in the business? What's my COGS over revenue, which is my percentage of my top line margin? How about labor? What's my labor cost versus my revenue? What's my labor cost versus my available cash, which is gross margin? How about those people at the top? What does my management team cost me as a percentage of gross margin? What do they cost me as a percentage of revenue? Am I top heavy? Why am I top heavy? Am I built for the next $20 million of revenue? Or am I built for today? And then in your expenses, you look at relative fixed and relative variable. Everybody has fixed expenses. Everybody has variable. You have to look at them both fixed and relative, both absolute and relative. So the story points, this is from my group, because they know I love this, tell you how to find the inflection points. And the inflection point is where the business meets success. So margins are variable, revenues are variable, expenses are variable, fixed are fixed. Certain things are indisputable fixed costs. And the inflection point is where revenue, less your fixed, plus the variable at that point equals 0. That's where you cross the line at that moment in time, where your fixed is covered, plus whatever the variable was up to that point, and your revenues match up, and it equals 0. Everybody get that? So the inflection point is what we call scale. That is the point where you can scale a business. That's how you get growth. And this is shows you an illustration and a chart of what it is. So, I got 2 of these screens, so it's not fair, but if you look at if you look over here at the yellow line, that's your revenues. So your revenues are going up. The assumptions are we got 33% margins in the business, $15 million of revenue in this year, fixed expenses are $3.25 million, and your incremental variable expense is 10%. And what I mean by incremental variable expense, it means that after you cross the inflection point, you still have 10% of expenses that are there. You don't get a free ride. It's not all dropping to the bottom. You still have expenses against it for somebody to do something. The inflection point in this is right there. Where orange crosses the gray is your inflection point in the third quarter. And the inflection point is $11 million of revenue and $3.55 million where they match up. So it took you $11 million to cover $3.55 million of expenses at that precise moment. And the reason it's the inflection point is because that's what you wind up with at the end. $15 million of revenue gave you $1.1 million of operating income. So it took you $15 million through the first year to get to 1.1. In the same year, here's the punchline. The next $10 million on the existing platform that you built, same people, same infrastructure, same everything, if you were able to shove $10 more million into that model during that year, the difference is that 10 equaled 2.4, whereas before it took you 15 to make 1.1. You did 2/3 of the revenue, and you made over twice the money at the bottom line. That's called free cash flow. That's the punchline of everything here. That's the ownership. So by doing all the things we talked about, you're trying to build a platform that's right-sized. Everybody's heard the word right-sized? To be able to scale the business. The assumption here is that this business could have kept the same people, same fixed expenses, same everything, and handled $10 more million worth of business. They didn't need more people, they didn't need more money. They had built it right. That's a scalable business. And that's how you have to model your businesses to success. So here's the question. Are you reacting or managing? I have a saying, businesses are living entities. You have to respect them. A lot of people don't respect them. They just kind of walk in them, live in them, go to it, and leave. They're living. They're like children. They need lots of attention. And sometimes when you're on the phone, you're going to feel that tug on your arm. But you got to pay attention to it. Greek philosopher said the only constant in life is change. In order to get to this kind of position, you'll have to change. You'll have to go there. And the proactive or reactive choice is totally yours, because if you go back to what I talked about in controllable versus uncontrollable, there are things you can control and things you can't. But what you can control is to be either proactive or reactive in how you run that business. Everybody here knows who Yogi Berra is? Because this is the end of the story. Everybody know Yogi Berra? Famous Yankee philosopher? Okay. I'm going to tell you two things about Yogi. Yogi was with Mickey Mantle at a pizza restaurant. They went out to dinner one night. And the waitress comes up and she says, "Oh, Mr. Berra, it's nice to see you." And she said, "What are you going to have?" And he said, "Well, I'm going to have a pizza pie." And she said, "Oh, great." She said, "Well, would you like that cut up in 6 slices or in 8? And he looks at her and he thinks, and he says, "You better give me 6. I don't think I can eat 8. So the point of that is be careful how you cut up your pizza and only take what you can digest. And as Yogi also said, as this whole story goes, when you get to the fork in the road, take it. This is your fork in the road. You can be proactive or reactive. I suggest you take it, but take it. That, I believe, is the end of the entertainment portion of today's presentation. And if you want the slides, I saw people taking pictures and notes. If you want the slides, I'm more than happy to have that forwarded to you and send that out to you and make that available to you. And Kelly tells me I have 4 minutes and 30 seconds left for questions. So I'm glad to take any questions. Yes. Oh, wait, I got to do the microphone thing. Where's Terry? Terry, you're slacking.
Thank you. What, if anything, would you recommend using a line of credit for?
Well, I would definitely recommend using it, but I think that a line of credit can be highly effective as in what it's called. It's called a revolver, and the idea is to borrow and pay back. So when you have short-term cash positions, I would do that. If you have an opportunistic buy of inventory for a program, that's a great place to do it. If you need to invest in something that you know has a 12 to 18 month return on investment, that's another great reason to use it. Where I would not use it is to make payroll, and then make another payroll, and then make another payroll, and run yourself right up to it, and then decide that you're just going to have an evergreen line of credit where you're never going to pay the principal back, and it's just sitting there, because eventually the bank will call it. But for those kind of short-term things, I think it's great. We have a line of credit, and in 2 years we haven't used it at all, but believe me, I keep asking them to give me more and more credit on it in case I need it. Yes.
Matt Sachs for the presentation. You talked about how to look through the financial statements to navigate through the business turbulence, and can you give some tips on how you use technology to grow the business and go through that process?
Sure. Would you be a technology guy? I think technology is very, very important. We have invested a tremendous amount into technology. We've partnered with Salesforce. We're changing over our ERP. We're building programs for customer experience and investing with partners who have different platforms that we can access. Bringing tools and experience to our consumers and our clients, which we like to refer them as versus customers. And I think technology is one of the most powerful things that this business has at its fingertips that is completely ignored. It's underinvested in technology in this business, in my opinion. And I think that's one of the big advantages that we have. The efficiencies we're starting to realize now because it's a magnitude of effort, but the efficiencies that we're starting to realize, the return on that investment, on Salesforce alone, the incremental ramp up is steep, the cost is steep, but the return is already starting to come through in the data that we can see. We know who's doing what. We know where the activity is. We can see where the margins are coming from, and we understand our clients better, our inventory is going to be better, our sampling is going to be better, and all of that is efficiencies that drives money down. It will pay for itself, I believe, within a year, at least twice over. Does that answer? Okay. Anybody else? Yes, sir. The finance major.
Thank you. You said you're pretty transparent in your company with sharing the numbers. Are there numbers worth to not be shared? And is this policy of transparency regarding numbers applied only to management or with everybody in the company?
That's a very good question. And the answer is you want to share as much as necessary so as not to confuse them, but also to inform them as fully as possible. So management sees deeper numbers that make sense to them because we don't want to sit around and have people confused or teach finance classes, but the entire company knows what we're doing as it relates to them. Even the warehouse guys are educated on some of the numbers that they produce and what they're doing, but everybody in the company knows exactly what we do in revenues. They know what kind of profitability we have. They know enough to know what's going on and have a feel for it. And in certain cases, it's like anything else. You can drown people in information unnecessarily and create confusion where they don't understand it. But we give them the whole picture. Sometimes we just give them the abridged version.
Are there numbers just for you and your CFO?
No, I share the numbers. Our sales team share. The whole team's right here. Everybody knows the numbers. We don't care, and that was a big change. And it was a swallow moment, because it was a cultural change. But I think that it's fair to say that the culture has dramatically changed for the better by having everybody understand what we're doing and where we're going, and everybody's in the same boat, rowing the same way, helping each other, and we truly, I mean, I don't mean this to just promote, but we truly have established a culture that I think is the best culture I've ever been in any company. It's open, it's transparent, they care about each other, they like each other, and there's no politics in it. It really defeats all the political stuff because nobody's trying to game anybody for anybody else. You know, and we were fortunate to have good owners that allowed us to do it. Although I did ask forgiveness, not permission. Anybody else? All right. Well, I just want to say thank you very much. I know time is valuable. I know that you have a lot to do with this show. I really appreciate you spending the time with me here. I hope you got something out of it and that it was worthwhile for you. So on behalf of myself and my team, I want to thank you very much for coming and attending this.